The next long-term pattern on our list is the channels. This long-term pattern is a powerful continuation and reversal formation. A channel is a simple chart pattern that has two trend lines, one at the bottom and the other at the top. They can appear as a rising or descending channel. The rising channel has a bearish technical implication, while the descending channel has a technical bullish implication. Before ever planning to trade this pattern, we need to know the qualities which make a channel to be considered a reliable one. These factors are: number 1, a reliable channel must have well-filled edges. Number 2, a reliable channel should have at least altogether a total of 5 points of upper and lower rejection of channel. The more upper and lower rejection the channel has, the more reliable the channel becomes. Number 3, a reliable channel should not have too steeply sloped. The slope must be moderate. The angle of inclination should not be higher than 50 degrees and not lesser than 10 degrees in a bearish trend. While in a bullish trend, the angle of inclination should not be higher than negative 50 degrees and not lesser than negative 10 degrees in a bullish trend. Here are the 3 most important factors to take note of when determining the reliability of channels. As a trader, do remember this is not a guarantee, because no trading system or setup is infallible to the market. Now that we know these reliable factors, we can now proceed to learn how this pattern works in the market. This pattern is a good player for the continuation and reversal of trends in the market. First, let's discuss the continuation approach of this pattern on the trading chart. How can we use the channels for the continuation of a bullish trend? To apply the channel long-term pattern for the continuation of a bullish trend, we need to make use of the descending channel. Also, we need to ensure the market is liquid and in a trending bullish phase. Here's an example of a descending channel in a bullish trend. As we can see, the trend was in a bullish rally. Price made a bearish pullback, which resulted in this descending channel. We were able to construct a descending channel here. Price tested the lower trend line 3 times. Price tested the upper trend line 3 times. The 4th upward test led to a bullish breakout. Price retested the broken channel here, and a piercing candlestick pattern formed. The best zone for stop loss would have been at the low swing here. We can see how the bullish trend resumed its previous bullish move. This was a massive 650 plus pips move upward to this high here. Take note, a retest may not occur in a fast-moving trend. Let's search the market for an example of this type of breakout. Okay, good. As we can see in this bullish breakout of the descending channel here, price made swings test of the lower trend line of the channel 2 times. There were swings tests of the upper trend line 5 times. There wasn't a retest after the massive bullish breakout here. The higher swing low and the bullish outside candlestick pattern here gave the signal of the next strong potential bullish move. This pattern resulted in the continuity of the previous bullish trend with a 370 pips price movement upward. How can we use channels for the continuation of a bearish trend? To apply the channel long-term pattern for the continuation of a bearish trend, we need to make use of the ascending channel. Also, we need to ensure the market is liquid and in a trending bearish phase. Here's an example of an ascending channel in a bearish trend. As we can see, the trend was in a bearish rally. There was a formation of an ascending channel here. Price broke out to the downside here, but there was a consecutive bullish retest of the broken support of this ascending channel. This is one of the reasons it's better to implement our stop loss at the last swing that leads to the breakout of this pattern. We can see how the third swing retest failed. The bearish trend continued its previous bearish rally, with additional 275 pips move downward. Let's search for a market condition in which there isn't a retest after a bearish breakout of this pattern. Here's a great example for us to study. Price broke the ascending channel here. We can see there wasn't a retest of the broken lower trend line of this channel. Let's study the previous swings, which occurred before price broke this support trend line of this channel. As a technical student trader, what can you notice here? We can construct a dynamic resistance trend line here, from this lower high here to the lower high here. Also, study the broken structure of the last higher low here. This bearish breakout occurred through a strong bearish candlestick here. Let's connect a minor support level here. The summation of the upper dynamic trend line here and the lower minor support level here gave us a descending triangular pattern formation. We will discuss this pattern in a later study of this course. We can also see that the bearish candlestick ensured a close of candlestick to the support of the ascending channel here. We can see this bearish breakout resulted in a 205 pips downward price move. To take a bearish or bullish breakout of a channel pattern, make sure there's the formation of a higher low swing to the upper trend line of the descending channel and a strong price action candlestick pattern before buying the bullish breakout. Also, to trade the bearish breakout of an ascending channel, ensure there's a lower high to the lower trend line bearish breakout. Avoid taking channel bullish or bearish breakout without these listed factors. I will show you how to implement the channel for the reversal trend in the next video. Take your time to master the continuation strategy before proceeding to the channel reversal trading strategy.